What's up everyone, it's Scotty with Money Investing. We are going to be talking about Upstart, which rallied close to 40% after hours. This absolutely insane move to as much as $19 a share after hours. And this right here was the entire move, close to 39%, trading as much as $19.66. So we're going to break down exactly what happened, why the rally, why the aggressive momentum coming in. And again, hope you guys enjoy this video and find it helpful. It was up already 5% on the day. So overall, if you compare from how much it was up, from today and of course after hours, close to 45-46% in the green after on the day today. So again, hope you guys enjoy this video, find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below if you're interested in joining, and of course getting access to all the buy and sell alerts, options alerts, trade ideas. Everything's going to be included with the links down below. There is a 16% annual discount also available till the end of this month that you can take advantage of. So this right here was the actual number. So they did kind of switch up their presentation a little bit. First, let's just talk about the earnings. So earnings came in at negative 47 cents per share, which was a lot better than what the analysts were forecasting. They were estimating for negative 82 cents per share. And revenue came in at $103 million, which was also a beat better than what the expectations were at 99.7 million. Now, the interesting thing is that, the markets are really built on expectations. And nobody really cares about the year-over-year numbers or quarter-over-quarter numbers. I mean, what is highlighted the most is what the expectations are and how the companies are doing with those expectations. And Upstart here, revenue, guess what? Declined 67% from same quarter last year. 67%. But nobody talks about that, do they? And then EPS, still a loss, right? Still a significant loss per share, 47 cents. But hey, it was a lot better than what we were expecting. So the stock rallies. So this right here is the entire candle from after hours. At one point, it was trading as much as $21.75. So very, very strong move to the upside. And of course, pushing up over 39 to 40%. So they now have 2.6 million plus customers with over $32 billion worth of originations and 99 banks, leading banks that they are partnered with. So Upstart is a leading AI lending marketplace. Again, if you want, credit cards, financing, refinancing the auto loan, personal loan, consolidating debt, mortgages, they do it all, right? So they are pretty much enabled with AI. So $103 million, down 67% year over year. Loss from operations, $131.8 million compared to $34.8 million operating income same time last year. Contribution profit margin 58% compared to 47% same time last year, and net loss was $130 million, which was obviously a loss compared to same time last year when it was a profit of $32.7 million, and adjusted EBITDA of coming in at $31.1 million. Some of the other highlights, so they've got over $2 billion in long-term funding over the next 12 months, 84% of loans fully automated that have been originated, and 23 new AI models have been launched, including the largest accuracy improvement to date, and a couple other OEMs added. So we got Acura and Mercedes, and 99 leading partners when it comes to lending and banks, up from 50 same time last year. So their business highlights are improving, that's for sure. But what's not actually growing is obviously the revenue, the operating income, or the net income. And the part of the reason is because of the economic landscape, because of the higher interest rates. Activity when it comes to loans and financing has obviously come down. There's been a credit crunch, and because the cost of borrowing is higher, obviously people don't want to borrow anymore. And because of those reasons, we're seeing lower revenue. And since the revenue started coming down and their fixed cost, which was SG&A marketing expense, was flat or even higher, they're seeing losses on both the operating side and on a net basis. So as I mentioned before, Upstart really needs to kind of get through this hard period of 2023, maybe even 2024. And if they can survive this period of the next couple years and they come out on the other side stronger, then I think there's going to be a lot of potential for this company to once again regain profitability. Because Upstart is not a company like Shopify or Square or Palantir, which has been unprofitable for 5 years and now it's turning the corner towards profitability. No, it was profitable. It was in fact extremely profitable up until 2021, and then you can see that 2022 was a brutal year which basically hurt Upstart's profitability. They went into losses And now we're starting to look like it's going to turn the corner once again. You can see that quarter over quarter over here. Very significant slowdown in revenue, and of course the margins going from positive to negative, and we're now generating losses after losses every single quarter. But the expectations are that they are going to eventually turn things around. So you can see that 2023 is expected to be negative $1.17 per share and eventually turn into positive once again. So 70 cents to $1.40, that's 100% growth in 3 years. That's where the high growth once again comes in, and this is going to be that revenue. So you can see that, again, a decline in 2023 and start going up again, and quarter over quarter you can see that. Very simple. If you were to kind of simply put up a line and how this is actually moving, you can simply do that by looking at, okay, it was going down, and then it's now starting to go back up again. So that really is what the expectations were, are, and are going to be moving forward. So moving forward, we've got the best rates of all. So when it comes to their AI, they provide superior risk separation. And that's actually their USP. That's really where they shine, is where they are offering 53% fewer defaults at the same approval rate. So in other words, if large banks are approving somebody and Upstart is approving somebody, even though they may have same approval rates, Upstart is assessing risk better, so they've got lower defaults. And when it comes to more approvals at the same default rate, so in other words, they are approving more people than the large US banks, but the default rate is, again, very, very similar to the large US banks. So in other words, both of these slides are really showing us that Upstart's AI is doing a better job in assessing risk than their large US bank counterparts. So that is really where their big USP comes in. That's why Upstart is the business, because of their AI lending and the risk separation. So this right here is going to be their overall numbers. So again, declines and losses all across the board. And cash is sitting at just about $451 million, with loans sitting at almost $1 billion. I'll break down the composition of those loans. It's mostly made up of auto and personal. And total assets at $1.8 billion. Total liabilities just under $1.2 billion for the company at the moment. Now you'll notice that the face value of these loans has declined. So they've come down from $1 billion down to $987 million, but we're still significantly higher from same time last year when it was at $600 million. So we have seen a 50% increase in those loans on the balance sheet. And this right here is going to be that composition. So again, loans held on the balance sheet. So $982 million is that number, 987 to be precise. And $401 million is coming off of auto loans, and $92 million is coming off of other loans, and $489 million out of core personal. Now this is, core personal is definitely a little bit more on the risky side because it's personal loans, and that obviously is unsecured line of credit, and people, if they borrow money personally, what are the guarantees, right, that they're going to pay it back? Now, it really comes down to how efficient and how good Upstart's AI risk model is, because if it's not, and eventually we find out that, later down the road that there's going to be some problems, then obviously this is not going to get repaid and the borrower is going to start to default. And that becomes a bigger problem for Upstart. But with auto loans, there's a little bit less risk, because if the borrower defaults, of course, you can seize the car and kind of sell it off for parts or salvage whatever you can. But the composition of these loans are still a bit more on the risky side, because 50% of it is made up of core personal. So that is something that we have to understand. But then again, you gotta really weigh in on how good Upstart's AI is with respect to default rates and its risk assessment. But because if it's extremely good, then this core personal doesn't make much of a difference, and it's still going to be good enough. So really the bottom line is that Upstart is going through a time where they're going to find challenges in 2023 and probably even in 2024. The bank failures certainly are not helping the situation. So as we are noticing, the first quarter, second quarter is also expected to decline, and the third and the fourth quarter, they are expecting to maybe turn the corner once again towards profitability. So it's really just a question of, can they survive, right, in this time period where there is a lot of uncertainty, where there is credit crunch, where interest rates are going higher, they're staying higher for longer, inflation is a little bit more elevated, and consumers are really starting to pull back on their borrowing and spending needs. So that's the real question, because if they can, then yes, the valuation starts to make a lot of sense at these levels, considering that it's trading at around 1.3 times sales, and we don't have a price to earnings multiple, and only 1.6 times book value. So it starts to make a lot of sense, starts to become very, very cheap and undervalued. Of course, after hours, we're up 40%, so we're going to have to account for that as well. But it is a high risk, high reward stock, right? It is what it is. So if you're looking for something that is going to offer tremendous amount of upside and growth and high reward, but are willing to also accept that there's going to be high risk involved with it, Upstart is one of those stocks out there. And the resistance going into tomorrow is going to be the one at close to $26. You can see that we have gotten rejected here at this level, back in October of 22, this right here back in February of 23. So we have consistently gotten rejected here at these prices. And of course, Upstart is known for being one of the most volatile stocks out there with a beta that's really, really high compared to the market. So that's going to be my entire breakdown on Upstart. No fair value assumption right now because, again, the company's not profitable yet. I think I did do a fair value assumption in the past, but again, if the company turns a corner towards profitability again, then we'll start to take a look at it. But right now, I think we're only seeing a rally based on beating expectations and coming in with a much better than expected loss per share and better than expected revenue, even though both numbers are terrible on a year-over-year basis. So I hope you guys enjoyed this video, find it helpful. If you did, make sure that you drop a like. Resistance tomorrow at $26. Support level is going to stay put at $12. And link's going to be down below with that 16% annual discount if you're interested in joining our money investing community, getting access to all the buy and sell alerts, options alerts, trade ideas, and everything included. So always happy investing, and I'll see you all in the next video.